to that in a second. So.
And we are live. Everyone joining us live. Very excited to have Chris Norval in here teaching us how to be our own bank. Your minds will be blown. There'll be questions about how possible it is for things to be this magical by the end of this presentation. But rest assured, the path to getting beyond that disbelief is short, and we are led by a very able captain. So to that end, I introduce Chris Norval, who will take the reins here and guide us in this very powerful lesson. So thank you.
All right. Well, hey, thank you all for having me, and thank you for joining me. I understand that it's pretty early for some of you, and if everybody's coming in from all over the country and all over the world, so this is going to be really exciting. So what I like to do is I always like to start this off with just really reading a little bit from the back of the book. But I also like, to acknowledge how much I respect your time and your energy and effort to actually being here to learn something new. So what I want to do right out of the hole is I want to give all of you a copy of this book. So everything you're going to learn today is in this book. We just launched this book, and I want to give every one of you this book for free. Now, I can give it to you in hard copy. You just have to pay the shipping, and I'll give you a link for that, or you can all have it in ebook. So I want you to have this book, because after you're done with this, just like he was saying, your minds are going to be blown. Okay. And you're going to have a lot of questions, but that's okay, because I'm going to give you an opportunity to speak with me direct to answer those questions. But also you might have some additional questions that you don't get. So that's what the book is for. So let me sum up what you're going to learn today just by reading you this. What if you could get all the money back for every purchase you've ever made, and if you could create wealth through your own debts and expenses that you already have? If you're like most Americans, you've spent your entire adult life paying the banks, paying your creditors, and your expenses. And at the same time, you've watched your retirement funds and your legacy dramatically fluctuate or evaporate in the markets. You've literally been taught to give up control of your finances, but yet you've been taught to assume all the risk, and it's costing you your financial freedom. This is what I do. I teach people how to take back control of their money. And not only that, I solve the money problem. That right there that I just described is the money problem. And that problem is not the problem that the wealthiest people face. That's what I realized. When you heard my story the last time when I told it, I realized during that journey of failure, success and then failure, success and failure, I realized that the wealthiest do something differently. And that's exactly what you're going to hear. In today's presentation, you're going to learn about a 200-year-old banking system, a 200-year-old strategy used by the wealthiest to eliminate debt, grow their wealth, minimize taxes, and leave a legacy. And then I'm going to show you how to do this in a very simple way, but this system will show you how to build your wealth, how to keep your money in your family, how to pay off debt and expenses, and how to recycle and recapture the money that you're giving away to everybody else, just like conventional banks do. Literally, I'll teach you how to be the bank and mimic exactly what they do. And in all of this, the one thing that you're going to love to hear is you can do all this without taking on any risk, without working any harder, without changing your cash flow, and without losing control of your finances. So today, when we're done, everything changes in your lives, because today you get to become the bank. That's a caption on the back of this book. You guys are all going to get that, but really, let's dive right in. You already heard my story. So what I always like to do is I like to just start real quick with a quick video. Let me get my slideshow up. Yeah, man. There we go. Flip my presenter mode there. Perfect. So just on this page, if you guys all want, that is my direct cell phone. You want my number? There it is. Okay. That'll ring right to my phone. So if you guys want to take a photo of that or write that down, it's 716-320-0119. And there's my email, contact@chrisnoggle.com. So with that being said, and you're going to have that number again if you miss it, but here's a quick video that just kind of sums up who I am. All right. So a lot of people get scared of sharks, but to be a surfer, you got to just play with the sharks. You know what else I'm really excited about is I get to spend. So for those of you that don't know, today's my birthday. I turned 43 today. So 43 beautiful years on this life. So I'm excited I get to share
Happy
that with. Oh,
birthday!
thank
Whoop,
you. I get to share it with all of you.
whoop.
So it's yeah, awesome, awesome. So right here, if you look, I consider every single one of you that is on this call as the 5%ers. And the reason I call you the 5%ers is you're willing to do what the other 95% are unwilling to do. You're on this call, you're learning something new, and you're spending the time and the energy to do just that. And the funniest thing about the 5%ers is if you looked at what the Social Security Administration says, this is statistically what they will tell you. 5 out of every 100 people will be the only ones that are financially secure at the age of retirement. So if you think about that statement right there, think about what that means. That means that out of 100 people in a group, only 5 of them are going to be ready for retirement. I don't know about you guys, but I see that as a huge problem because the last time I checked, whether, I don't know if you're all in the United States, but the United States, like this is supposed to be the greatest country on earth, the land of opportunity and all that stuff. So if that's the case, how can this be real? You know what I see this to be? This means there's going to be a lot of 65, 75, and 85-year-olds working into their retirement, not because they want to, but because they have to. My grandparents were exactly that. My parents are exactly that. They are that statistic. Well, that changes for all of you right here and right now. So getting into it, you already heard my story. So I'm going to dive right into exactly what we're going to talk about today. You see, what we're going to talk about today is going to seem too good to be true. I can tell you that right out of the hole. I know once you're done learning what we're going to learn, and I'm going to teach you how to build wealth. I'm going to teach you how to create extra money for your family, for your living expenses. I'm going to teach you how to pay off debt. I'm going to teach you how to build a legacy. I'm going to teach you where to find money for your real estate deals. And I'm going to show you how to do all this without changing a whole lot, because all we're going to do is we're literally going to mimic what the wealthy have done for hundreds of years. We're just going to follow the same path they've followed, and we're just going to do it in a simpler fashion using their exact same methods. But when you're done with this, the one thing I have to ask all of you is you have to change your way of thinking. Because the one thing that's been a problem your whole life is you've been taught money works a specific way. And literally what I'm going to show you today is going to be something that has never been taught to you. And you're going to look at it and you're going to say, it can't be that way. I've been taught it works this way. Well, everything you've been taught mostly about money has either been self-serving to someone else or just flat out a big lie. And that's going to be hard for you to adjust to. But I ask you to keep an open mind throughout this presentation. And when you do think during this that this looks too good to be true, I want to very quickly remind you 2 things. Number 1, I'm not here to sell you anything. I'm simply here to teach you how this system works and how you can apply it in your life. Number 2, if it was too good to be true, then why are people like this writing about it in their books? You've probably all heard of this guy, Robert Kiyosaki. He's written a couple books. This one right here, Second Chance, great book. Not as good as Rich Dad, Poor Dad, but good. He talks about it in this book. You all might know this big jolly guy, Tony Robbins. Yep. Page, I think it's like 52.6 in his book, how he does it. He talks about this concept that we're going to talk about. And then another book, Becoming Your Own Banker. This is the book that started it all. R. Nelson Nash is the founder of the modern day version of what you're going to see. He took what the wealthy were doing back in the late 90s and brought it to the world, to the masses and to everybody like you and like me, so that we could all benefit from what the wealthy have known about the entire time. So real quick, I've got this little video in here. It's about a bike. And we all, when we were children, we all learned how to ride a bike, right? You remember how that went. Your parents put you on a bike. That bike probably had training wheels at the beginning, but we learned that if we push the pedals down, the bike goes forward. And then we learned if we turn the handlebars to the right, the bike goes to the right. If we turn them to the left, the bike goes to the left. Simple. We got that down, right? Then our parents did something very cruel. Our parents took the damn training wheels off. Do you remember what happened? You crashed. That's what you did. Some of you crashed, you got bumps, you got bruises, you skinned a knee, you cried a little, but you know what you didn't do? You didn't give up. You got back on that bicycle and you learned how to ride a bicycle. Some of you went on to do wheelies and 360s, but you mastered the art of riding a bicycle. But what would happen if we took that same bicycle? And what would happen if we just changed one thing on that bike? And that one thing was what you see right here on the screen. What if now, when you turned the handlebars of that bicycle, the bike went to the, like if you went to the right with the handlebars, the bike went to the left. And if you turn the handlebars to the left, the bike went to the right. Essentially, this is the backward bicycle. My question to all of you is, how many of you actually think you could ride this bicycle? Do any of you think you could ride the bike? Well, the answer is none of you could ride this bike. And we're going to prove that in just a second. But the reason you can't ride this bike is not because it's impossible. It's simply you weren't taught to ride a bicycle like this. And really, that was only one thing that changed on this bicycle, but that one change made it so you could not operate and ride this bicycle. Well, see, the same exact thing is true with money. When it comes to money, you've been taught that money works a specific way. When you deposit money in your bank account, you have a preconceived notion of what happens with that. When you put money in a retirement account, you have a preconceived notion of what happens there because that's what you've been taught. But what if we change just one thing in that whole game? And what if we just changed where that money went first? The question is, what would that mean? Could you understand how money works if one thing was changed? Well, let me play a quick video for you because I think I've got it in this one. And this video is just awesome. So we're going to take a few moments. And in this video, you can watch on YouTube. So if you love it, share it. It's on YouTube. It's called The Backward Bicycle. I'm going to play this right now.
Can you make sure you share the sound, please, Chris? Because I don't think we heard the sound on the last video.
Oh, you didn't?
Yeah. On the options, it should be share sound as well.
Share
on
computer
the
sound.
option.
So you guys didn't even hear the music on my video?
No, we just saw your really cool. We saw your really cool singing.
The music's the best part. Thank you for telling me about that because I never knew how to do that, and I've had that happen a few times. All right, so now if you could just give me a quick thumbs up if you hear this.
Okay.
Hey, it's me, Death.
Can you hear that? All right, let's roll it.
Welcome back to Smarter Every Day. You've heard people say it's just like riding a bike, meaning it's really easy and you can't forget how to do it, right? But I did something. I did something that damaged my mind. It happened on the streets of Amsterdam, and I got really scared, honestly. I can't ride a bike like you can anymore. Before I show you the video of what happened, I need to tell you the backstory. Like many 6-year-olds with a MacGyver mullet, I learned how to ride a bike when I was really young. I had learned a life skill and I was really proud of it. Everything changed though when my friend Barney called me 25 years later. Where I work, the welders are geniuses and they like to play jokes on the engineers. He had a challenge for me. He had built a special bicycle and he wanted me to try to ride it. He had only changed one thing. When you turn the handlebar to the left, the wheel goes to the right. When you turn it to the right, the wheel goes to the left. I thought this would be easy, so I hopped on the bike ready to demonstrate how quickly I could conquer this.
And here he is, ladies and gentlemen, Mr. Justin Salem. First attempt riding the bicycle.
All right. So the faster I go, the better. Yeah.
I couldn't do it. You can see that I'm laughing, but I'm actually really frustrated. In this moment, I had a really deep revelation. My thinking was in a rut. This bike revealed a very deep truth to me. I had the knowledge of how to operate the bike, but I did not have the understanding. Therefore, knowledge is not understanding. Look, I know what you're probably thinking. Destin's probably just an uncoordinated engineer and can't do it. But that's not the case at all. The algorithm that's associated with riding a bike in your brain is just that complicated. Think about it. Downwards force on the pedals, leaning your whole body, pulling and pushing the handlebars, gyroscopic precession in the wheels. Every single force is part of this algorithm. And if you change any one part, it affects the entire control system. I do not make definitive statements that often, but I'm telling you right now, you cannot ride this bicycle. You might think you can, but you can't. I know this because I'm often asked to speak at universities and conferences, and I take the bike with me. It's always the same. People think they're going to try some trick or they're just going to power through it. It doesn't work. Your brain cannot handle this. For instance, this guy, I offered him $200 just to ride this bike 10 feet across the stage. Everybody thought he could do it.
No, you didn't understand. You didn't understand. So, this way. Okay. All right, a second. All right, so, whenever you're ready. Wait. No, you have to keep your feet on. Dude, all right, give it a go. Wait. Like, you gotta start rolling at least. Keep your feet on the pedal. Go.
Once you have a rigid way of thinking in your head, sometimes you cannot change that, even if you want to. So here's what I did. It was a personal challenge. I stayed out here in this driveway and I practiced about 5 minutes every day. My neighbors made fun of me. I had many wrecks, but after 8 months, this happened. One day I couldn't ride the bike, and the next day I could. It was like I could feel some kind of pathway in my brain that was now unlocked. It was really weird though. It's like there's this trail in my brain, but if I wasn't paying close enough attention to it, my brain would easily lose that neural path and jump back onto the old road it was more familiar with. Any small distractions at all, like a cell phone ringing in my pocket, would instantly throw my brain back to the old control algorithm and I would wreck. But at least I could ride it. My son is the closest person to me genetically, and he's been riding a normal bike for 3 years. That's over half his life. I wanted to know how long it would take him to learn how to ride a backwards bike, so I told him if he learned how to ride a backwards bike, he could go with me to Australia and meet a real astronaut. Are you gonna give up?
No.
Go ahead. This is how it starts. Look at this. This is such a big deal. Get up, you got it. Did you see his brain get it? So in how many weeks have we been doing this? 2 weeks? In 2 weeks, he did something that took me 8 months to do, which demonstrates that a child has more neuroplasticity, am I even saying that right, than an adult. It's clear from this experiment that children have a much more plastic brain than adults. That's why the best time to learn a language is when you're a young child. All right, today's bike log. I can ride smooth, I can ride fast. I'm thinking the experiment is over. Okay, now I'm in Amsterdam, a city that has more bicycles than people. The question is, can I ride a normal bike now? I mean, I've spent all this time unlearning how to ride a bike. If I go back and try to ride a normal one, will my brain mess up? So I've tweeted a Smarter Everyday meetup, if you will, and I'm gonna see if somebody brings a bicycle and I'm gonna try to ride a normal bike. It's backwards, it's backwards. This was one of the most frustrating moments of my life. I had ridden a normal bike since I was 6, but in this moment, I couldn't do it anymore. I had set out to prove that I could free my brain from a cognitive bias. But at this point, I'm pretty sure that all I proved is that I could only redesignate that bias. So what you're not seeing is just a group of people here looking at me, looking at the strange American that can't ride a bike because they think I'm dumb. But I'm actually 2 levels deep into this because I've learned and unlearned. All right. After 20 minutes of making a fool out of myself, suddenly my brain clicked back into the old algorithm. I can't explain it, but it happened in a very specific moment. I got it. I'm back. Oh, it clicked. Hold on, it clicked. I got it. Okay, there it is. There was the moment. Okay, I can ride a bike. I tried to explain this to the people around me, and they just didn't get it. They thought I was faking the previous 20 minutes, and I couldn't get anybody to believe me. That looked like I faked that, didn't it? Yeah. Just a fake. You think I'm faking. You don't believe me. You think I'm lying, don't you? I'm not lying. I felt like the only person on the planet who had ever unlearned how to ride a bike, and I couldn't articulate it to anyone because everybody just knew that you can't forget how to ride a bike. So I learned 3 things from this experiment. I learned that welders are often smarter than engineers. I learned that knowledge does not equal understanding. And I learned that truth is truth, no matter what I think about it. So be very careful how you interpret things because you're looking at the world with a bias, whether you think you are or not. I'm Destin.
So that's the video. I don't know what you guys thought of that, but the most important takeaways from that video is to understand this. MacGyver mullets are making a comeback because of Corona. It's your biggest takeaway. That's what you should have gotten out of that video. No, seriously, like that. It's funny to see that thing in Amsterdam where he's trying to ride a regular bike that he's learned his whole life, but he can't ride it because he's changed his way of thinking and he's learned to ride a backward bike. Well, that exact video I can relate. When it comes to money and I talk to people, I have a hard time relating to how they have been taught money works. Even though I was a financial advisor for 16 years, sometimes when I look at people, the way they handle money, they deposit money in a savings account or a bank account, they let it accumulate there, and over on this side, they accumulate debts. And then they always think that this money over here shouldn't be taken out of my savings because that's my emergency fund. And I could go on for days. I don't keep much money in savings and bank accounts because I now know how money works. I don't put any money into a qualified retirement plan because I want control of my money. So that that video demonstrates my viewing on how money works. And I'm hoping that after today, you're going to begin your journey to how money really works, and you will never look back. Just like he couldn't ride that regular bike, I can't ride the regular money game anymore. I just can't. So let me test your knowledge when it comes to money. Now, can everybody be unmuted for just a moment? Because this would be a fun thing to share. Is that possible? All right. So I'd like you all to participate in this. And, it's just a fun little thing, but this is going to test your knowledge about money. The very first thing, and we're only going to spend a few seconds on each one, but the first thing I want to ask you is, can anyone tell me what is the definition of money? And just freely just blurt it right out. What is the definition of money?
Just unmute yourself, guys. Unmute yourself and just say it out.
Oh, everybody needs more coffee. All right. Well, that was a failed attempt right there, but that's okay.
I think it's me. I didn't allow it.
No problem.
My fault. Sorry, guys.
No worries. All right.
Energy.
What did you say?
Money is simply energy.
Okay, that's one. Anyone else? What is the definition of money? Anything. Just what the first thing that comes to your mind. What is the definition of money?
Andrea, you should be able to unmute now. Yeah, go for it.
There we go.
I thought you tried to unmute because you had something to say.
No.
Money is a medium of exchange. Money's a medium
I'll
of
say
exchange.
it's a currency. It's a currency.
Okay.
Yeah.
So, the number one thing, and you nailed it. Money is nothing more than a means of exchange. Think about it. Money for food, food for money. Money for car, car for money. Money for house, house for money. All we do is exchange money for goods and services. So it's a means of exchange. So that's the first one. Secondly, if I were to ask every single one of you, what company in the world uses compound interest? The answer almost always will be banks, okay, or Wall Street or something along those lines. But the answer to that is there is not a business, not a company in the world that uses compound interest. So if you really think about it, what do banks do? Banks do not use compound interest. Banks charge you compound interest. Banks pay you compound interest. They do not use compound interest at all. And to make that, just kind of drive that one home, I want you to think about when you go to the bank and you make a deposit in the bank. If you took a dollar bill out of your pocket, okay, and you wrote on your dollar bill, and let's just pretend this is the dollar bill, you wrote your name really big across that dollar bill, and you gave it to the teller and you said, Mr. and Mrs. Teller, I'd like you to take my deposit and put it in my little box that you have in the back, the one with my name on it. 30 days from now, next week, sometime, I'll be back and I'll grab my money back. Is that how a bank works? Absolutely not. Matter of fact, you give that dollar with your name on it to the teller, that dollar's gone forever. Because what banks do is move money. The cubicles behind you, they're loaning that money back out to somebody else. Banks are constantly in the business of moving money. Just like everything in the universe is in motion, money is also in motion. And if money sits still, it is stagnant. We have been taught to give up control of our money and just leave it sit still because we've been taught to believe that compound interest is what we should do with our money. But yet there's not a business that does use compound interest that there is. Wall Street doesn't use compound interest. Grocery stores certainly don't use compound interest unless you like eating stale food. They move the inventory off the shelves. The inventory is their money. Car dealerships do the same thing. And to go one step further, let me ask you, would you ever eat a fish out of a stagnant pond? Chances are you wouldn't. If you're going to eat a fish, you want it coming out of a flowing river, a big flowing river that's always moving. Well, your money is that flowing river. It always needs to be moving. When you have more of it, it contracts, just like a river does. When you have less of it, expands. When you have less of it, it contracts. The only time water gets stagnant is when it takes a crick off the side and it ends in a stagnant pond. The only thing in stagnant ponds is dying, is leeches and parasites. You wouldn't need anything out of a stagnant pond. But we've been taught that that's what we should do with our money. On top of that, is your money worth more now or is it worth more in the future? Your money is worth the most today. And if you don't believe that, how many candy bars could you have bought 20 years ago for $1? The answer is simply more than today. So it's safe to say that your dollars are the most valuable right now. And that is a fact. And especially here in the States where they just printed, what is it now, up to 3-point-something trillion dollars. When they print money, folks, just so you all understand, that money has no value. You see, back in the days of Fort Knox, dollars were valued with gold. But the leprechauns figured out how to make a rainbow right over to Fort Knox, and they stole all the gold. So now money, dollars, have no value unless they steal value from your current dollars. Hence, it's called inflation. So when they print money, your dollar that you have becomes worth less and less. A lot of people think of inflation as a gallon of milk going up. That's not what happens. Your dollars, it just takes more of them to buy that same gallon of milk. It is a hidden tax. So why are we taught to give up our good dollars today, the dollars that are worth the most, give up those dollars to be paid back someday later with weaker dollars? Just trying to get you to think about what's actually going on here. Secondly, do taxes go up or do they go down? If you really think about that, most of you would say taxes go up. But the fact is, taxes don't always go up. Sometimes they don't go up at all. But you know what they do? They find more crap to tax us on. If any of you have ever visited Florida, Orlando, Disney World, when you're driving down Florida's throughways, there is a toll booth it seems like every 1/8 of a mile. I swear to God, you can't even drive without hitting a toll booth. Tolls are taxes. Now, the state of Florida might not have a state tax, but they found a way to tax you on everything else. So if taxes always go up or they find more crap to tax us on, then why is it that we're taught to put money, our good dollars, our most valuable dollars, into retirement accounts? So I'll tell you why. And I was guilty of this exact same thing. I shouldn't say guilty, but this is what I was taught. My grandma said, Chris, when you get a job, make sure you find out if they have a 401k, Chris. And if they have a 401k, ask if they match and then put as much money as you can. Because Chris, you don't want to be like Grandpa and I working into our retirement. You want to have enough money saved so someday you can retire, right? The retirement dream, which is sailing off into the sunset in your whatever it is, that dream isn't real. You see, what we're actually being taught to do by our peers, our grandparents, the friends, the family, because that's what they were taught, we're taught to give up control of our most valuable dollars. Think about what you do when you put money in a 401k or an employer-sponsored retirement plan. You give up control of those dollars to the financial institution. Sure, you get a tax deduction today on your dollars today. That money grows in the markets or doesn't. It grow. And then someday later, here in the States, magic age is 59.5. Then we can take our money back out. And at that time, when we take our money out, it's all taxed. If it's a traditional, not a Roth, but it's all taxed. And we took back weaker dollars. During that whole period of time that we had our money there, if we took our money, in most circumstances, there's a penalty for taking it. So we literally have given up control of our money. But the funniest thing about what I just said there about retirement accounts is what we're doing with money is the complete opposite of what we do with things that money buys. I want you to think about this. Would you ever go out and buy a loaf of bread from your grocery store? You bring home this nice loaf of bread, you put it in your freezer and you close your freezer door. And then you wait 5, 10, 15 years. You come back, you open that freezer, you take that loaf of bread out and you look at it and you say, oh, I can't wait to eat that. Yum. You wouldn't eat that. It'd be freezer burned. You would never eat that loaf of bread. Okay, let's do another one. Would you ever buy a car and wait 5, 10, or 15 years to drive that car? You would not. Would you ever buy your dream house and wait 5, 10, or 15 years to move into that dream house? No, you wouldn't. And if you did and you were married, you wouldn't be anymore. But you see, we do things with money we would never do with things that money buys, because that's what we were taught to do. And the other thing that I always ask about retirement accounts, because I was an advisor, so I know the answer, but I always ask, what do people actually know about their retirement accounts? Well, hold on, let me tell you what they know. They know that when they get their statement, if their balance went up or down. Some of them know if they're in conservative, moderate, or high risk tolerances. That's what most people know. Now, listen, I'm not saying retirement plans are evil and you shouldn't do them at all, because some of you receive a match, which is free money that your employer gives you on your retirement account. Now, I will always tell people, and this is a different school of thought, if you get a match of 3%, well, then contribute 3%. But why are people contributing 15%? Because remember, you're getting a pre-tax deduction. That's what people tell me. I get a deduction on that money I put in. Great. So what you're doing is you're agreeing to me that you'd rather pay tax on the harvest than you would pay tax on the seed. Think about that, right? Haven't you always been taught to pay tax on the seed, not the harvest? We do the complete opposite when it comes to our money. I'm just trying to, again, get you to start thinking about what's really happening, what's really been going on, and to get you thinking about what actually is you do with your money every day that you are going about transacting business. Now let's talk also about how your money flows, and how I'm going to do that is through this example. And I'm going to pretend that all of you are, well, one of you are going to buy a new car this year. And in an audience, I usually would ask, is anyone buying a car this year? And somebody says yes. So we're going to buy a $25,000 car. Now, how can you buy a car? There's technically 4 ways you can buy a car. Number 1, you can basically go out and you can pay cash for the car. You can exchange your dollars for that depreciating asset, and you now have the car, and the seller or the bank gets the cash, right? You could do that. You could go out and lease a car. In that, you exchange monthly payments for the right to drive a car, and then you just get to give the car back. The bank won the whole time. 3, you could take a loan out and finance the car. In that, you exchange credit and monthly payments for the right to own and drive a depreciating vehicle. And the 4th way, which isn't really a good way, is you could always steal your car. But I'm not going to talk about that because I'm assuming none of you are out there stealing cars. But it is a legitimate way that you could have a car. So you're going to buy a $25,000 car. And what we're also going to assume is that you have $25,000 at your local conventional bank. And your local conventional bank is paying you 4%. Now, I know your bank isn't paying you 4%, but let's pretend that you found yourself a really, really good bank today. And because you found a really good bank, I'm just going to play your banker, Banker Chris. So that really good bank is paying you 4%, and you need a car. So you come into the bank and you say, Banker Chris, I need to take that $25,000 out of that really good bank that you're managing. And you know, I know I'm making 4%, but I need to take that money out to buy a car because I don't want a monthly payment. And I think about it as your banker and I say, well, no, hold on a second. How about this? How about our really good bank makes you a loan for that car? So we're going to give you a loan for that car, and we're going to charge you 6%, and we'll give you the term of 60 months on that loan. And all we're going to do is take that $25,000 that you have in our bank that's earning 4%, and we're going to hold that money as collateral. Sound good? Well, most of you are thinking that's not really a great deal because I'm making 4 and you're charging me 6. Okay. But then me as your banker, I say this. I say, I knew you were thinking that. I knew you were thinking it's not such a good deal, but what if I make you this promise? Our bank will pay you more money on your $25,000 earning 4% that's sitting there than you will ever pay us on that $25,000 loan at 6% over the same time frame. What would you say to me? Would you say, no way, that's not possible? Chris, you've lost your mind now because 6 minus 4 is -2, man. I'm losing 2%. I don't know what you're smoking today, but that doesn't make sense. Are some of you thinking that? You should be, because math is math, right? 6 minus 4 is -2. So how can I promise you as your banker that your $25,000 earning 4% is going to earn more than you're ever going to pay us on that car loan? The math doesn't add up. So let's run the math. That monthly payment on that $25,000 car at 6% over 60 months is $483.32. You could go to bankrate.com and check my math, but that's what it is. Meaning over 60 months, you will have paid $25,000 for the car, and then the rest of that $28,999 is interest, correct? Well, now let's go over to your bank. Now your bank, remember, your money has been sitting there earning an uninterrupted 4% interest over the exact same time frame of 60 months. And over that 60 months, how much has your bank balance grown to? Right there, $30,525. So now, is $30,525 more than $28,999, or do we do math differently here in Buffalo, New York than you do in your town? It is more. It's actually $1,526 more money. So you got to be asking yourself, how in the world can I have made more earning 4 when I was paying 6? You simply don't understand how uninterrupted compound interest works. You see, your $25,000 has been compounding on itself over 60 months, going up and growing at a faster momentum as it's going. The $25,000 loan is nothing more than simple interest, and you're also paying that simple interest down. So one is going up, the other is going down. The only reason that example is important is because it proves to you all day long you can earn more earning 4 when you're paying 6. That's the only thing I wanted you to understand there. We'll come back to that in a moment. So what I'm going to go over with you today is our method. It's called the money multiplier method. It is a 200-year-old system, been around for a very long time, created by the Rockefellers back in their era because they didn't trust banks. So they had to find a better way to create banking for their money. So what does this money multiplier method consist of? First and foremost, we got to have a machine. Okay, every business needs a machine, and our machine is going to do nothing more than be used to move our money. That is key. I want you to all remember that. The machine we're going to use is simply there to move your money in the most efficient manner. That is the only reason we're using the machine we're going to use. Secondly, this is the hard one. You have to understand that building wealth is a marathon. It's not a sprint. Life is a marathon. Life is not a sprint. So when you're thinking about building wealth, outside of striking it rich at the, winning the lottery, and also just so you know, more than 90%, I think it's even higher, 90% of all lottery winners go broke in the first couple of years because they never understood how to keep the money, so they just give it away and lose control of that money. But building wealth is a marathon. So what I'm going to show you is not some get-rich-quick thing. It is a marathon, and it will take you years to build this system and make it work the way you're going to see it. Lastly, the end result, whatever your goals are. I don't care if it's paying off debt. I don't care if it's becoming a millionaire. I don't care if it's, getting all the money back for every car that you're ever going to buy, drive, and own. Whatever your goal is, this system will help you get there faster, smarter, and more efficiently. So now what we're going to do is we're going to move on. Now we got to talk about that silly machine that I just said we're going to use, that machine, the engine that we're going to use to move your money. What is that machine? This is the part where I always either lose some people or get some people really asking some questions. So let's just get this right out of the way. The machine we're going to use to move your money in the same machine that the Rockefellers used, the same machine that Ray Kroc used, the same machine that Walt Disney used, and I could keep going on, the person who founded Pampered Chef and on, all use this machine, and here's what it is. It is nothing more than a dividend-paying whole life insurance policy from a mutually owned company. Now, at this point, all of you should be saying, son of a beep, beep, what the heck does a whole life insurance policy have to do with me building wealth, Chris? And I usually watch the numbers. We had 12. Usually I lose a few at this point. And I usually lose a few because people think they know what they don't know. And Will Rogers said it best, and we'll get to this later in the thing. Will Rogers said the biggest problem in America is not what people don't know, it's what they think they know that just ain't so. So right off the bat, now that we've got the monkey out, or whatever you say, like the truth is out, what you're thinking is you're thinking that you know what whole life insurance is, which you probably do. It's a life insurance policy, money that gets paid to somebody when they die. But see, that would assume that you think there's only one kind of whole life insurance. You see, what we're going to talk about today is nothing like what you are used to. It is a whole life, but it is a whole life that is completely engineered and designed to do something 100% different than what your standard life insurance policy, does from a life insurance store, so to be. Not only that, why would we use this machine, this specially designed and engineered whole life, to basically do what we're going to do? Well, let me tell you why. It's because this is what the wealthy do. This is what the banks do. Matter of fact, banks are the #1 owners of whole life insurance in the world. If you don't believe me, that right there, bank-owned life insurance, Google it. BOLI. Google BOLI, and you will find hundreds of pages that will come up showing you how much money banks own in whole life. And if you look at companies like Bank of America, one of the larger banks, you'll see Bank of America actually owns more whole life, not regular off-the-shelf whole life, but the stuff we're talking about. They own more whole life than they do all the land and the buildings combined. Now, any of you, if you've ever driven around a big city, how many banks are there? There's big skyscrapers with bank names. There's a branch on every single corner. How is it possible they own more whole life than they do all the land and buildings combined? Well, I'll tell you why. They know something you don't know. That's all there is to it. So moving past that, you remember back that car in that really good bank example? You know what this is? This is exactly how money works using this machine. You see, a specially designed and engineered whole life from a mutually owned dividend paying company pays you a guaranteed 4%. Guaranteed, never to change, never to fluctuate. It's guaranteed to pay you 4%. On top of that, they pay dividends, but I didn't use dividends. So if that really good bank was nothing more than a specially designed whole life that paid you 4%, and you use that specially designed whole life to buy your car, and that car cost you 6% interest, which we're going to cover how that works, it's just proving to you that you can make more earning 4 when paying 6. That isn't a bank. That is what the Rockefellers figured out on how to use specially designed whole life as a banking system, which is exactly what I'm about to teach you. But first, before I can teach you how to create a banking system, you have to understand how a bank works from the get-go. So here's how a bank works. Now, these numbers are just going to be made up. So don't get hung up on the bank or on the numbers, just like you shouldn't have got hung up on the car. Because some of you were thinking, man, I'm not driving a $25,000 car. This system works whether you're driving a Ford Pinto all the way to a Ferrari. We just add some zeros. So again, don't get hung up on these numbers. They're just an example. So how do we operate with banks? Well, we go to the bank, we take our dollars, and we deposit our dollars into the bank. And then in return, in some cases, not all, the bank pays us an interest rate. And we're going to pretend that this bank is going to pay you 4%. So you deposit $100,000 in the bank in return pays you 4%. Now, we already went over this, but what does the bank do? The bank moves your money. The natural law of the universe is movement. So the bank knows that money has to move. You deposit the money in the bank, to you, that's an asset. Okay. You get excited about making deposits. And if you don't, well, I don't know if I'm talking to the right person. I get excited making deposits in the bank. That's money that I have. It's an asset. But to the bank, your deposit represents a liability. You don't like liabilities. They're not good, right? So the bank knows that. So what does the bank do? It converts liabilities into assets by making loans. So the bank takes your money and loans it out to your neighbor to buy a house. And your neighbor exchanges their credit and a monthly payment for the keys to the car. So that bank loan, called a mortgage, goes to that neighbor. They buy their new house. Thank God you didn't like your neighbor, so they're gone. True story. I use the neighbor thing because I don't like my neighbor, and they're moving right now. So I'm actually pretty excited. So that's a real life example. So my neighbor just got a mortgage for their new house, and that money goes to the seller. The seller deposits the money back in the bank, creating a new liability for the bank. But this loan represents the asset, and it's a money-making asset. They turn around, they lend that money right back to you who made the deposit for your brand new shiny M4. And the bank charges you 8%. You exchange the car loan to the dealership for the keys. And again, we repeat the process. Money goes back to the bank. Bank then loans the money back out to somebody for a home remodel loan, home equity line of credit, or a rehab loan. They charge 9%. You then pay the contractors. The contractors deposit the money back in the bank. You see what's happening here, right? Money in, money out, money in, money out, money in, money out. Then you're so excited about your new M4. You're so excited that the bank's paying you 4%. You take a trip to Las Vegas. And on that trip to Las Vegas, your luck wasn't really so good. You put it all on black and it struck on red. Darn it. So you racked up the credit cards. You come back. It's okay, folks. What happens in Vegas, so they say, stays in Vegas. So we'll just leave it there. But you come back and you go to the bank and you get a debt consolidation loan. Now, unlike all these other loans, this is the only loan that is not secured. So they charge you 12%. And you pay off the credit cards, then the credit card companies deposit the money back in the bank. This is the circle of how a bank works. But now let's look at how much money did the bank actually make on your deposit? Well, if you take the 4 they're paying you minus the 7 that your neighbor's paying, that's 3%. So the bank made 3. If you take the car loan, 4 minus 8 is 4. Okay, 4% that they're paying you minus the 9% remodel loan is 5, and 4% minus the 12% debt consolidation loan is 8. How much money did the bank make on your money? Well, they made 20%. And this doesn't factor in fractional reserve banking. This is just assuming 100 is 100, which it's truly not. So the bank made 20% on your money. How many of you would be okay making 20% return on someone else's money? All of you would be. All of you would be okay probably making 20% on your own money. Well, that's how much money the bank made. But does anyone yet pick up on the problem of what I just said? You see, the bank did not make 20%. The bank made 500% on your money, because there's the math equation's right there. If you're making 4 and the bank is making 20, isn't that 5 times more than what you made? Right. The bank made 500% more than you did. But the fact of the matter is this. See, everything I'm going to tell you today, I can back up with factual data, and I'm going to do that. This is what banks make on the money that we leave there. Banks on the money that we leave there, whoops, what the heck just happened? They make 400 to 1,300% on the money we deposit there. And if you don't believe me, right there, BauerFinancial.com. You can put any bank, any time frame, anywhere, and you can see how much money banks make on your deposits. And it will always be 400 to 1,300% more than you make. It's facts. But that's okay, folks. Don't get mad. Don't hate the banks. Mimic the banks. You see, banks do good things. You never have to go very far to go and find a bank to make your deposits, do you? There is a brand new, shiny new property on almost every corner, and it's a bank, so that it's convenient for you to open new accounts and make more deposits. If you got more money, there's not a bank far away. So they invest your money wisely. They open more branches so that they can raise more deposits. Why wouldn't they? Well, that's the numbers. But not only that, my favorite part about banks is they're always giving something away for free, right? I go into the bank and I make my deposits. And, you know, right at the bank teller, right above there's always a mug, right? There's always a mug right up here. And I always look in the mug, and I'm short, so I kind of got to like do one of these over, and I grab a lollipop. There's always a lollipop. The lollipops you can get in any flavor you want. It can be grape, it can be cherry, it can be watermelon, whatever your flavor is, you pick that one. I like the lime, and you eat it. But then you unwrap it and you look at the wrapper. What does the wrapper actually say? In every bank I've ever been in, maybe different in different countries, but here in the States, that wrapper says dum-dums. What the hell are they trying to say to us? They're calling us dumb. I don't know. Maybe they own the sucker company that's called Dum-Dums, but you know, sometimes you just got to connect the dots. That's a true story, and I think many of you could agree that that is what the sucker says. Dum-dums. See, my wife figured it out. My wife, before she was pregnant, we had a little one. She figured out when the bank did wine tasting. And it was once a month, and she'd always be like, Chris, I'm going to go to the bank and do deposits. She'd be gone for an hour and a half, 2 hours. I'd call her up. I'm like, honey, are you okay? Did anything happen? No, I'm still at the bank. Wait a second. You're still at the bank? She's like, yeah, they got a wine tasting, and Jill's here, and Susie's here, and oh, they gave me an umbrella. I'm just trying to poke fun at this, but the banks are at least giving some of the money back that they're taking from us. So let's talk again about what we have been taught to do with our money. This is the annual pattern of spending. You see, out of every dollar you make, most people statistically give up 90% of every dollar we make. And here's how they do it. 20 cents of every single dollar you make goes to the automobiles, okay? Then 30 cents of every single dollar goes to housing. 40% or 40 cents of every dollar goes to mortgage or everything else, diapers, food, entertainment. So what do we keep? 10%. But let's talk really about what's happening there. What if all you had to do is change just one thing, like that bicycle? If you had to just change one thing, and you could take back the interest that you're giving away to everybody else. Well, what would be the impact of that example that I just gave you if you could just take back all the money that you're giving to everybody else? It would be huge, right? Most people in the United States save, well, it's probably different now with COVID, but prior to COVID, it was 6%, not 10, 6 was the average savings rate. So if you're giving away 90 and you're only saving 6, the rest, who knows where that goes, there's a major problem. But how do you take back that money? Well, it's simple. Let's start with your automobiles. What if you knew a way to buy automobiles where you could get all the money back for every single car you will ever buy, drive, and own? What would that do to your savings? Well, let's just do it. If you could, out of that 20 cents that you spend on automobiles, roughly 5 cents of that 20 goes to interest that you pay to your car loans. So if we could just take back that 5% that you're giving to those automobile finance companies, look what that just did to your savings. Over on the right, you see how your savings just got bigger? It went from 10, now you increased it by 5 cents. So that's a 50% increase in your savings. And all you did is change one thing and took back the interest that you're giving away to the finance companies. Let's keep going. This one is a very important one, so I'm going to take a little time explaining this. Housing. Out of the 30 cents you spend on housing, how much of that 30 cents are you giving away in interest? Well, it's right there, 25 cents. Out of the 30 cents you spend on housing, you give away 25%. You probably aren't understanding that, so let me dissect that. How many of you have a house mortgage or have had a house mortgage in the past? And out of those of you that said yes, how many of you have ever looked at your statement when it's come in the mail? You get the statement for the mortgage statement and you look at it. And I want you to look at two different things. One, you look at the interest, okay? And number two, you look at the principal. In the first 7 years, of this bank mortgage, how much of your payment, your full payment, is going to interest and how much is going to principal? I bet you many of you probably don't know. Some of you are like, a lot. You're right. 80 to 85% of every single payment you make on your mortgage payment in the first 7 years goes to interest. The remaining amount goes to principal. If you've ever wondered why your mortgage never seems to get paid down in the beginning, that's why. You see, banks have tricked us, not even tricked us, we've just been tricked our whole lives, lied to about this. It's not about the interest rate, because you all know that. Right now, interest rates are at the lowest they've ever been. You can buy a mortgage and get it for like 2.75% fixed for 30 years. And you're so excited, it creates momentum in lines, and there's not even enough housing to support the need for housing right now because mortgages are low. But what I just told you, didn't I just tell you that like it doesn't matter really? It doesn't matter what the interest rate is. The bank's getting all the interest in the first 7 years because they have figured out the volume of interest. You see, it's not about the interest you earn, it's about the volume of interest. That's what banks figured out. So in the volume of interest, banks have not only figured out how to play that game where they get all the interest, they've also figured out how often we buy new houses, or how often we refinance. And the marketing strategies that banks do are tied around this. If you look statistically, the average person moves every 5 to 7 years. Let's just call it 7 years. Every 7 years, the average person moves to a new house, or they refinance their old mortgage every 5 to 7 years. Think about your life. Have you ever refinanced your mortgage because of a lower interest rate or maybe a cash out of the equity? You probably have. I certainly have. And by doing that, you restart that clock on what I just said. When you refinance or you buy a new house, the clock starts over and 80 to 85% is going to the banks. This is how the banks are always winning. They're always winning, and it's not, don't be mad at them. Just realize they know something we don't. And if we could just find a way to then take back the interest that we're giving to the bank and put that money in our account, we'd take back 25%. Now, I went long on that because that's so vitally important, because a lot of people don't understand that and they go and refinance, not understanding the ramifications of refinancing. If you're refinancing to pull equity out, that's different. You then have to understand, where is that equity going to go where it's going to earn you more money? That's the key question. I'm not here to talk to you about that, but that's something else I teach. Everything else, diapers, going out to dinner, going to Disney World, whatever you spend money on, out of that, that's 40 cents. Roughly, we use, well, 5 cents of that is interest because we use credit cards. If you didn't need credit cards, or you knew a way to use your credit cards, but every 30 days you could fully pay off your credit cards and not have to pay any interest, you would then take back 5 cents of every dollar. Look at that savings now. Did we change anything in your life doing this? No. All we did is changed one thing, and that's who got the interest. We didn't work any harder for this. We didn't work any longer. You didn't lose control of your money. Matter of fact, you took back control and you took on no risk. All you did is took back the interest you're giving away. If you want to learn how to build wealth, this is how you do it. Stop thinking what they've told you is the way. Work harder, work longer, get a promotion, get a bonus. Sure, those things all work for today, but that is not how you build wealth. Because what most people do is when they make more, they spend more. What we need to start focusing on is not working more, not spending more. We need to work on taking back the money that we're giving away to everybody else. So all of you should start after today's training is take a piece of paper and draw a line down the middle. Over on your left side should be all your income. On the right side, I want you to write down who you write checks to every month. And then I want you to circle the ones that really piss you off when you write a check to them. Visa, Discover, Amex, all the credit cards that are dinging you 20 to 25%. And then I'm going to show you how to take that money back from them, and you then can pay yourself because you're going to be the bank. So let's discuss how to do that. But before we get into that, how about I just show you how to get all the money back for every single car you will ever buy, drive, and own. That would be a good thing, right? If that's all you learned today, that would be a valiant thing that you spent your time to learn. So that's Eleanor, just so everybody knows. The machine that we talked about, that's specially designed and engineered whole life, first we have to look under the hood because you have to understand what that machine actually does, because you have a misconception still about how we're going to use this specially designed and engineered whole life. You see, first thing, When you think of a whole life policy, you think of it as a premium payment, like your car insurance, your homeowner's insurance, your medical insurance. We hate making payments on premiums, don't we? Because it's money that goes out for something we don't really get any benefit from unless something bad happens. But if you think of what we're actually doing, we're not making a premium payment here. We're making a deposit. Just like you would make a deposit into your bank, we're creating a banking system, so you're making deposits. For every time I'm going to talk about premiums, I'm going to call them premium deposits, because you're truly making deposits into this mutually owned insurance company. Secondly, I hear this every time, even after people watch this, they say this: I'm too old. I just got on the call yesterday with a woman, sweethearts, and they said, no, we're too old for this. I'm 60 and she's 66. We're just too old to do this. I laughed. I said, don't you remember in the video when I said age doesn't really matter? We're not creating a life insurance plan because of the death benefit. We're creating it for the banking aspect. So age, although it does play a factor after 70, age really doesn't matter. As a matter of fact, if I took a 30-year-old and a 60-year-old and I put the exact same dollar amount into this policy, 10 grand, and I did it for the exact same time frame, they would both have the exact same cash. They would have the same amount in their account. But you know what would be different? The death benefit. You see, that's what we change. We build these backwards. The death benefit would go down the older you get. The younger you are, the more death benefit you're going to have. The older you are, the lower the death benefit will be, because we're always trying to build these with the lowest death benefit and the highest cash. So let's get into the numbers. In full transparency, this illustration you're about to see, these numbers, they're old and they suck. But it's okay, because you know what? I'm going to show you the worst numbers that I can possibly show you. All I want you to understand is these numbers are old. They're an old plan design that I haven't updated, and I keep it because if I show you these and you get excited about these, wait till you see what this actually looks like. So what we're going to assume, we're going to take an individual who's putting $10,000 per year away. Now, I don't mean they're writing a check for 10 grand. They might be putting $833 a month in. You are all saving money somewhere, or your money's going somewhere. So we look at that and we figure out, how much are you saving today? Whatever that is, that's your number. You just change one thing. What you're saving over here, you move it over here. We're going to use an example of 10 grand, and we're going to put 10,000 away for 7 years into this specially designed and engineered whole life. And then every year, we're going to have money in that policy. Okay. So most of you, if you have a whole life, the one thing I can certainly tell you, and I'm going to get my little fancy dancy. Oh, I don't have the option. Never mind. I usually have drawing tools, but I don't. But I'm going to show you right here, year one. If you deposited 10 grand, you immediately in the first 30 days would have access to $58.73. That's roughly 58% of every penny you put into that account. You would have access to take that money right back out. Most whole lives, the ones you buy off the shelf, there's no money year one, there's no money year two, and there's hardly any money year three. So how is it that there's money immediately? I'm going to cover that. But you deposit 10, you got 5,800. So the next year you deposit another 10. The next year, your account balance grows to 12,000. Okay. The next year you deposit another 10 and your account balance grows to 25,000 plus the 42. So it's 29,204. You put in 30, you have almost 30 in your account. But in year three, what we're going to do is we're going to take 25,000 out and we're going to buy that car. But now what we're going to do is we're going to do one thing different. If you went and you took a loan for a car, you'd have a monthly payment. If you leased a car, you'd have a monthly payment. Well, here, I want you to think of your account as your bank. You own the bank, which means if you take money from your bank, you should indeed pay yourself back and pay yourself back with interest. So what we're going to do is we're just going to write a check back to our bank for the exact same amount you used to give to someone else's bank, $500 a month. So you took the 25,000 out, you bought the car, and now what you do is you write a check for $500, but that $500 goes back to you, and that $500 is immediately available and usable by you every single time you deposit it. You see, you're probably thinking, well, that's silly. If I paid 25 cash for the car, why would I pay myself back with interest? Because you need to start valuing and treating your money the same way you treat the bank's money. If you're okay giving the bank payments with interest, why in the world would you have a problem paying yourself back with interest? Good question, right? It's because you've never been taught to do it that way. But if you did do it that way, here's the outcome. Let's fast forward down to year 7. You bought a car, year 3. Year 7, the car is now 5 years old. So let's do the math. We put in $70,000 in savings over 7 years. 70 grand time, or 10 grand times 7 is 70 grand. We also paid that car back to our bank. So we put $30,000 back into our bank, which was the 25 for the car, 5,000 in interest. I just rounded up. So your total amount that you've put into your banking system in the first 7 years is $100,000. Again, don't get hung up on these numbers. This is just an example. How much money did you actually net in your account? Well, we had 100 that we put in, but we bought a car, so that was 25 that came out. So we actually put in $75,000 into our banking system net. Well, in year 7, how much cash do you have in your banking system? 67,881. That's pretty good. You paid you put in 75. You've got a car in the driveway. How much did you just get back for that car that's sitting in the driveway? 91 cents of every single dollar that you paid for that first car, you just got back, because you have 67,881 in your account and you paid out 75. Now, I bet you without any shadow of doubt, no one on this training right now has ever gotten 91 cents back for the car that's in their driveway if they didn't sell the car. Even if you did sell it, I doubt you got 91 cents back. So that's a pretty good system right there if you can get 91 cents back. But what did I tell you earlier? I wasn't going to show you how to get 91 cents back. I was going to show you how to get it all back. So let's go to year number 8. But in year number 8 through 12, we're never going to make another deposit into the bank. Now, I would never tell you to do this, but I like illustrating it. So years 8 through 12, we're never going to make another deposit in the bank. But what happens when a car turns 5 years old? Most cars start breaking down. They need tires, they need brakes. But you know what really happens? This is the reason we buy cars. The car loses its new car smell. So you and your spouse or significant other, you go over to the dealership and you start going into the new cars, sitting in them. As soon as you close the door, what do? You go, oh, it's the new car smell, folks. Don't kid yourself. That's why we buy cars. It's that stupid new car smell. And if you don't believe me, why do they have air fresheners that are new car smell? That's why we do it. So year 8, you need a new car. Even if your car's fine, you're still going to buy another one. So we buy a new car. And we do the exact same thing. We take money from our cash value, our banking policy. We buy a car for $25,000. Normally, you'd upgrade the car, but I'm just going to show the same car. And you repeat the process. You make $500 payments back to your bank instead of giving it to someone else's bank. And the outcome is this. You put no new deposits in, but you repaid yourself $30,000 for that new car that you just bought. Now, and I got to move this because the numbers are right over here where I can't see them. So now, right over in your bank, how much money do you have in year 12? $91,000. How much money did you actually put into your banking system? Well, $30,000 was the repayment for the car, but you bought the car, so you actually only put $5,000 in. So from year 7 to year 12, your account grew by $23,000. But let's do the math the right way, not the way that looks good on the screen. In years 1 through 7, we put in 75,000, right? And then in years 8 through 12, we put in a net of 5,000. So the total amount we put into this banking system is $80,000. In year 12, can anyone tell me how much money we have in our bank account? It's called cash value in the money multiplier account. 91,000. Did you get all your money back for those 2 cars that you just bought? You did. Every penny, and you made $11,473 on top of that. So right there, just with 2 cars, imagine what would happen with 3, 4, 5, cars, because you're going to keep buying them. You just got all the money back for every single car that you ever bought, driven, and owned if you followed this method. The math is right there. The math doesn't lie. And the thing you don't know yet is these numbers that I just used were only the 4% guarantee. I didn't even account for the 2.2% dividend that Mass Mutual pays this year. You see, I showed you the worst numbers, and this is how it worked in the worst case scenario. You should see this, how it really works. So that right there is proof that you can get all the money back for every car you're ever going to buy, drive, and own. So if that didn't get you guys excited, good. It should have got you really excited, because you know what else we forgot to talk about? Don't you have 2 cars in the driveway? One is now 10 years old and one is 5 years old. Do they have value? Absolutely. But does it matter what the value of the cars are? No, because you got all the money back without having to sell the cars. Maybe you gift the car to a charity. Maybe you give the car to a child, a grandchild, and that whatever you do with it, it doesn't matter. You see, this system will work every single time, no matter what, and no matter how you do it, if you just change that one thing. But you have to follow some rules. There are 3 rules. Number 1, you have to start paying yourself first. You would have had to have made these deposits into this specially designed and engineered whole life. Rule number 2, you have to start treating your money the same way you treat the bank's money and everybody else's money. In other words, you have to pay yourself back with interest. Stop cheating yourself and giving it to everybody else. Start making money yourself on your money in following rule number 2. Rule number 3, you have to recycle and recapture the money that you're giving to everybody else. You normally would have just given those monthly payments to the car dealership, finance company, or the bank. You're now giving them to yourself. So the 3 rules, just to reiterate, are right there. Pay yourself first, pay yourself with interest, recycle, and recapture your money. If it works for a car, what else does it work for? Planes, trains, automobiles, income taxes, vacations. I could go on for days. It will work for everything. My best friend puts money into this plan and he uses it to pay his taxes. Why? Because that is his pain point. If any of you have ever had a bruise, you don't sit there and just keep pushing the bruise, do you? It hurts. It hurts. We all have a bruise when it comes to money. My best friend, Brad, his bruise was paying taxes. So I just kept pushing on his bruise, just kept pushing on it. You like writing those checks to the government? No, I hate it. You want to keep making more? You're going to give them more this year, aren't you? Oh yeah, darn it. I'm so sick of it. Great. How about you get all the money back you pay to the government in taxes? How? Boom. I just showed him how. So what you just saw is not the most impressive part. What you're going to see next, and this is the final section to this training, is what's going to really blow you away, because this is very real and this should strike home with many of you. It's called debt. This system can be used to erase your debt in record time without changing anything. So in order to demonstrate this, I'm going to take a real client of the Money Multipliers. Can't give you his name or his details, but what I can tell you is this is his debts. Discover, Lowe's, Nordstrom, Wells Fargo, private loan for he was a chiropractor, for his chiropractic practice. He drove a BMW. He had a boat, because if you live by a lake, why not have a boat? And he had a condo on the lake, and he had his primary house. Those are his debts, okay? His total debts were $478,000. Now, $478,000 is one thing, but you know what? That's not the worst part. The worst part is that's his total monthly payments. So he's got a total in debt of $478,000. He's 43 years old. He was my age, actually. And his monthly payments were $5,777. How many of you would that not make you want to puke? If $5,777 was going out the door a month, $69,000 to all of these. And look at those interest rates: 21, 11, 3, 21, 10, 7.5, 9, 6.2, 4.9. They suck. That's your money going out the door every month. So we said to this chiropractor, he saw our presentation. He said, can you help us? And we said, I don't know. I don't know if we can. How much money are you saving now? So the chiropractor looked at his savings. He said, I'm putting this much in a savings account. This much is going into the retirement. It totaled $25,000 over the course of a year. And if you take 25 grand, you divide it out on a weekly or monthly basis, it's really not that much, but that's what he was saving. And we said, okay, Mr. Chiropractor, how about we just change one thing? Take the exact amount you're saving now, and let's just change where it goes, and then we'll open one of these specially designed and engineered whole life. Now, the second thing we do for all of our members when they start with us is we create a map, which I'll show you what the map is, but the map is exactly what I'm going to demonstrate. I'm going to show you how this chiropractor, who thought that it was going to take him 19 years to pay off this debt, why did he think 19 years? He did the math. He put in 478 into a fancy computer program, probably a Dave Ramsey computer program, put 478 in with the interest rates, and he put the 25 grand that he was saving in paying that debt down. If you did the math, it would have taken him 19 years. I'm going to show you how, by changing nothing else other than one thing, how this chiropractor paid all of this debt off in 6.5 years. So that's what I'm going to demonstrate. So let's get right into it. There's a lot of numbers, but just stay focused on what he does and how we do this. Okay. That's all I need you to look at. First thing he does, he deposits $25,000 into that specially designed and engineered whole life. So we've got their debts down here. I want you to watch these. 478, 5777 is what he's paying to everybody else right now. And he deposits $25,000. So as soon as he deposits that $25,000 into this account, he immediately takes out $14,863, which is the max amount he could take out of this account. When I say immediately, I am referring to immediately in the first 30 days. Why 30 days? Well, the insurance company has to clear your check. It's just like your bank. They operate the same way. He deposits 25 grand. 30 days later, his money is clear. He takes out 14,000 as a loan. Do you remember earlier that loan? When you take money out of these accounts, you're not taking your money. You're taking the insurance company's money. You see, they're loaning it to you and they're giving you an advance of your death benefit. So this 14,863, what you don't know is that's not his money. That's the mutually owned insurance company giving him a loan against his death benefit. So his death benefit just dropped 14,863. But now what did that allow his money to do? That allowed his $25,000 to continue to earn uninterrupted compound interest. In other words, the 4% guaranteed interest that he's earning on that money keeps compounding without any interruptions. The 14,000 is his to use. The insurance company gave it to him. The insurance company does charge him interest on that money, which I'll cover in a moment. They charge 5%. He's earning 4, they're charging 5, but he's actually earning 6.2 with dividends. So let's be clear about that. Takes the 14,863 and what's he do with it? Pays down Discover, pays down Lowe's, pays down Nordstrom. He then, by paying those off, he freed up $448 a month. That's how much money he was giving away to them. So what did I teach you with the car? You got to treat your money the same way as the bank. So what we did for this chiropractor is when we freed up the 448, we said to him, we said, look, that 448 doesn't have to go to Discover, Lowe's, and Nordstrom anymore, but now that money should go to you. So we had him open up a new bank account at whatever bank he was banking at. We're going to call that a segregated bank account. So that $448 a month that he used to give away, all he's doing now is through an automatic transfer with his bank account, the money goes from his regular account to this newly created segregated bank account. It's all it's used for, right? It's to hold his money. Let's go to year 2. Now that you understand kind of what's going on, let's keep going. Year 2, he does the same thing. But now you'll see he deposits 25,000. He immediately in the first 30 days takes out 16,000. The 16 is more than 14, right? Absolutely. Every year he's going to be able to take out more money than he was the year before because of uninterrupted compound interest. So he takes out 16,000, but now he has $5,376 in that segregated account. Because remember, he saved $448 a month and he just put it in that new account. So we take the loan of 16 plus the amount in his segregated bank account. He's got $21,000. We take the $21,000 and we pay off Nordstrom, Wells Fargo, the private loan, and we pay down the BMW loan. So what I'm doing, I see there's a ton of chats and a ton of questions. I am going to come in and I'm going to answer those after I'm done. I don't want you to think I'm forgetting about you. Okay. So all we did here is we paid off those 3 loans and paid down his BMW. So what does that do? That frees up, whoops, got to get my clicker back over here now that I moved that. That frees up $1,917 a month because we don't have $276, $271, and $922 going to somebody else that's staying with him. So he's got $1,917 a month that he used to give away. Now he's going to keep that and he's going to put it into his segregated account. But you see now just in 2 short years, he was giving away $57.77. Now he's only giving away $38.60. His debt went from $478 to $378, and he's putting $1,917 into this new segregated account. You guys are all with me. Year number 3, this is a magical year. Year number 3 represents something that we call the efficiency zone. So I want you to look. He deposits 25 grand into his account. Immediately in the first 30 days, can anyone see how much money he was able to take out of his account? Because the first 2 years sucked, right? He put in 25 and he couldn't take all of his money. He could take, I think it was like 58% the first year and whatever it is, 70%, 60% the second year. Now he puts in 25 and he immediately can take out 25,541. How many of you can walk into your bank, make a deposit in your bank account, come back 30 days later and take out more than what you deposited? The answer is probably none of you. You can here. He takes out 25,541 as a loan. Then he had the 1917 going into the segregated account. So he had 23,000 in that checking account, totaling 48,545. So we take that 48,545, we pay off the BMW, we pay off that boat, and then we pay down the condo, reducing his debt load to 283,000. His monthly payment to everybody else in just 3 years is now 2,100. Now, in reflecting on this marathon that I referred to earlier, this isn't easy for this chiropractor. I want to be clear. He didn't like paying the $57.77 before, and he's still paying hypothetically the $57.77 because that $57.77 is money he's laying out every month. It just used to go to somebody else. Now he's slowly taking that money back and paying that money to himself to further this whole thing. It's called velocity. So here's what the marathon looks like. 3 years, he put in 25, 25, 25. He put in 75,000. But every year, immediately in the first 30 days of making the deposit, he took loans, 14, 16, 25. He took out 55 of the 75 he put in. Now, let me ask you, how much money is he making interest and dividends on right now? Most of you would say, how much? Well, you would do the math and you'd say he's getting paid on 20,000 because you're thinking of this like your bank account. I had 75, but I took 55, which means I'm earning interest on 20. Wrong. He is earning interest on the full 75,000 he deposited. Remember I said he's not taking his money. He's taking the insurance company's money, meaning his money, the full 75,000 has been for 3 years earning uninterrupted compound interest plus dividends. Now, let me break it down. One of the main companies we use is Mass Mutual. Mass Mutual pays 4% guaranteed like all the companies we use. And then they pay this year alone, full transparency, 2020, the dividend is 2.2%. That is 6.2%. How much money is the insurance company charging him to take those loans? You got it, 5. What is 5 minus 6.2? 1.5. How many of you would love to deposit money in your bank, take all your money back out of the bank and still make 1.2%? Wouldn't that just be like, oh my God, boom, your head just exploded? Right. That's what can happen. You just have to learn how to do this because this is what the wealthy know. This is what the banks know. They can use their money and still get paid on their money at the same time. Miraculous. And this is how it works. And this is what Albert Einstein called the 8th wonder of the world. Look it up. Look up Albert Einstein's theory on uninterrupted compound interest. He says it is the 8th wonder of the world, the most powerful thing in the financial world. That's all we're doing, folks. We're tapping in to what Albert Einstein said was the 8th wonder of the world. But let's keep going. Year 4, deposits 25 grand. Immediately in the first 30 days, how much does he pull out? 26,304. See how it just keeps getting better? It's the gift that just keeps on giving. Okay, then he had 3677 in the green. That's the money he used to give away to everybody else, but now it's going into his newly created segregated bank account. So he's got 44 grand there. So we take 26 from the loan, 44 from the segregated account. We got 70,439. We pay down the condo. Now, have any of you ever made a like a principal payment on a mortgage? Nothing happens. It's self-defeating. Whoa, that was loud. You make that payment on that mortgage and your monthly payment doesn't change. Same thing here. His debt goes down to 162, but his monthly payment remains 2,100 to everybody else. So now we're going to go to year 5. Year 5, he deposits 25. He immediately takes out 27,090. And he was saving 3677 again in that segregated account, meaning he's got 71 grand there. So he's got 98,000, which is the loan plus the segregated account. We pay off the condo. We pay down the house. This chiropractor in 5 years flat only has $91,000 in debt, which is his primary house. He only has $1,221 in monthly payments he has to pay to somebody else, which is his mortgage, and he's keeping $45.56. Is he not excited or is he not excited? He could stop right here and that would be a monumental win, but you know what? You've never watched a professional sports game where they quit before the final inning or whatever game you're watching. Never. They always play the game through. So we said you got to play the game through. Year 6. Year 6, something different happened though. Year 6, that chiropractor was ready to just do the same thing, but then the IRS steps in on all of these plans and they create limits. So the chiropractor was going to deposit the 25,000, but he can't. He only could put 10 grand in his account. It's called the MEC 7 pay rule. Every policy we design will have some type of restriction where you can only put money in for a certain amount of time. This chiropractor hit that in year 6. So we only could put 10 grand in. So he deposits the 10 grand and he immediately in the first 30 days goes back and takes out 13,000. Can anyone tell me what the rate of return is, the cash on cash return is on this chiropractor's 10,000 he deposited? Well, if it's 3,000 he made on 10 grand, isn't that a 30% cash on cash return? How many of you would be okay making 10 or 30% on your money while you're still able to take that money out and use it? All of you would. All of you would. And if you really want to get in the weeds, take the 30 minus the 5 you got to pay to the insurance company and net 25% cash on cash. This chiropractor at this point was so thrilled with this. He's like, you know what? Since the insurance company only lets me put in 10, I want my second bank. I want to create another bank. So he went and he opened his second branch office, policy number 2, where he deposited 25 grand. He now took out the money from both, 13 from policy number 1, 14 from policy number 2. He was putting 45, 56 into that segregated account every month. So he's got 82,000 there. The total cash he has sitting on hand is 145. He owes 76 on the house. 6.5 years flat. He is debt free. He picked up 5777, not by working harder or longer, not by giving up control, and certainly not by taking risk, simply by following a system called the money multiplier method and using this silly, stupid, specially designed and engineered machine called a whole life. That's what he did. But how did he do that? You see, a lot of you are looking at a lot of numbers. You're like, I could never do that. I'd never be regimented enough. I wouldn't have the time to do that. Good. You're just like everybody else. Just like everybody else, you don't have time, which we know that. So as a company, what do? We create time for you. We do all the work through what's called a debt map. What you're seeing on this is that chiropractor's debt map. This is what we created. We tracked every deposit, every loan. We tracked every recapture when we paid the money down. We told that chiropractor, okay, by paying Discover, Lowe's, and Nordstrom down, you freed up $447.87 a month. Just take $447, go into your online banking, create a transfer from your regular account that you used to pay Discover, Lowe's, and Nordstrom from, and have that money go into this segregated account. We just created the guide, the GPS, the map, and we do this for every single person. And this is how we help people do what you just saw. To become a millionaire, how do you do it? Same way you'd eat an elephant, one bite at a time. And how do you get to the top of a mountain? Well, unless you got a helicopter dropping you off there, you climb one step at a time. Is it possible? A lot of people say, Chris, this is all great, man. That was awesome, but I don't have any debt. I say, awesome. You're way better off, because now it's not possible to owe no man nothing. You're going to have to pay taxes. You're always going to have expenses. So what about using this system to pay all your living expenses? After year 3, when that chiropractor was depositing 25 and he took more than 25, why wouldn't you be able to pay every single expense in your household using this? You would. And Brent does. My mentor does exactly that. He uses his credit card every month, all of his expenses. At the end of the month, takes a loan from his policy, pays off his credit card, gets the credit card points, boom, earns money on every penny of that money the entire time doing that. So don't think just because you don't have debt, this doesn't work. It works better. But we got to get debt out of the way first, because that's how we build wealth. That chiropractor, real quick, and I promise I'm almost done. I just want to show you what his real economic benefit was for just the house and the condo. So if he just continued paying the condo and the house off to the banks, this is how much money he would have given the bank, $493,000. But now he doesn't owe the bank that money. So how much money does he get to keep? $493,000 over those months right there, 251 months. But what did this chiropractor learn how to do? He learned how to earn a guaranteed 4%, right? So instead of taking the money and putting it in that segregated account from that 6th year on, what did he do? He took those payments and he put them right back into his policies. And he paid all those loans off that he took. So he earned a guaranteed 4% on that money, which means instead of having that 498, he now had 749. Didn't change anything, just made his money work harder and smarter for him. See, that's the problem. We've only been taught how to go out and work for money. We've never been taught how to make money work for us. This is what money working for you looks like, and it will always work exactly that way. By the way, I never once really talked about a death benefit, did I? But there is one, and it will be paid. The death benefit will be paid tax-free to your heirs if, when and if you graduate. You will graduate. We're all guaranteed to graduate someday, and graduate is the day we die. So the death benefit will be paid out. The loans that you were taking from the insurance company, you've never had a loan that doesn't need to be paid back, do you? Or have you? Probably not. Well, these loans technically never have to be repaid. Why? Because all we did with the loans is took an advance of our death benefit while we're living. We just took part of our death benefit while we were living. And that's how we were able to do exactly what you saw. The internal values, all tax-free. All that 4% growth, all those dividends, all tax-free if designed properly. And the best thing, Policies are exempt from judgments and liens. So I have doctors and surgeons and anesthesiologists that love this system because of that alone. If they get sued, nobody's piercing this valve. Nobody's taking the money that's in here. And if you don't believe me, look up a guy named O.J. Simpson and look up his net worth. He's still a multimillionaire. How is that even possible with how many times he's been sued? I just gave you the answer, folks, right there. His advisors knew a little something. Warren Buffett says if poor people would do what rich people would do, they wouldn't be poor anymore. Simply said, Bill Gates says, if you're born poor, that's not your fault. But if you die poor, that is your fault. People never, ever change that one thing. Therefore, they struggle. And this is the most important quote of the day. The problem in America isn't so much what people don't know. It's what they think they know that just ain't so. If you ever told somebody that you didn't, have watched this video all about this, they're going to tell you it's crazy. They're going to tell you that it's a scam. They're going to tell you whatever that comes to their mind because they've just never understood and learned what this is, but they think they know what they don't know. I think that's the most profound statement ever made right there. I'm done, but if any of you have additional questions for me regarding any of this, or if you really wanted to look at how this would work in your situation, this is how it's done. Again, I'm not here to sell you anything. And on a phone call, I'm not selling you anything. If this is something you think will change your life, I will help you set the banking system and the map and do all that up. But we have to do a call and you have to tell me about what you're struggling with. What is your money problem? And we're going to solve it. So text Money Multiplier to 33777 and that will send you my calendar and you will speak directly to either me or Steven if I don't have time within when you want to speak. And we'll then walk you through the process. And if it's something that works after we've both figured out, can we solve your problem? Great. We'll help you from there.
Chris, thank you so much. I think everyone is going to have to agree with me that is everyone's mind blown as much as I was when I first saw this.
Oh,
And
there's
just
so
a couple of
great
things,
questions.
guys. I know if you've got questions, I'm going to pick up with a couple that I know are going to be flying around, and then we can loop in with the ones on the chat. So obviously, I'm not from the US natively, but we spoke about how this works for someone that's not from the US.
Correct.
We've got people from Australia, from Europe, from Canada. How can people not from the US take advantage of this?
Sure. And Canada's easy. Canada, it works just like I just showed you. Literally, there's some minor differences, but my Northern Canadian members and clients works just like this. Australia, unfortunately, I have gone through extensive research on the UK and Australia. For some reason, your government just wants to control everything and they do not allow this. So unfortunately for my Australians, I can't help you with this, but what I'd love to do is come out to Australia and do some surfing with you. That's what I'd like to do for all you Australians. And then Europe, I do believe this works. I'd have to do a little bit more research, but I have heard in the past that Europe, in certain parts, this does work 100%. I just don't have that connections. But Canada, US, good to go.
Brilliant. What about if people have a tax identification number for the US?
Piece of cake. Got you covered.
Brilliant. Because for the credit that we're raising for people and helping people to leverage credit, we're showing people how to get their tax identification number. So if someone's got a tax ID, we can make this work in the US?
More than likely, yes. You might have to make a trip over here to US, and I'd suggest waiting till after this coronavirus thing's done. But yeah, so we've done it for many, many people that don't live natively here in the States, but there's a couple rules, but I'd be happy to kind of walk you through those.
Brilliant,
rules.
brilliant. Those are my only questions that I know will be on many people's minds. I'll let you pop through the chat and see if there's anything else that you want to.
Yeah, I mean, we hit a bunch of them, but there's one question JA said, what's the difference between whole life and universal life, or indexed universal life specifically? Everything is different. I hate indexed universal life. I openly say it. I openly dissect it, and I openly tell everybody why I don't like it. I've been in this business since 2003, and I was in the business when the invent of VULs came out, and I watched VULs crash and burn in 2008. IULs are a spawn off of VULs. Now, are IULs altogether terrible? No, they work for long-term goals like retirement. Will they do anything like what you just saw? Absolutely not. And if anyone tells you they will, they are blatantly lying to you. And I will literally bring me on the call. I'll have an outright discussion with them, and it might not be a fun one, but you know what? I know how they work. I literally have dissected them by the prospectus. That big thing you get with an IUL, I've read it, and I know what it says. The fees in IULs are astronomical. And the problem with an IUL is the cost continually go up the older you get. So if you got something you're trying to build wealth in and the costs keep going up, how is that going to work out when you're in your 70s, 80s? Well, I'll tell you how they show it to work out. It's called speculation. They give you hypothetical rates of return based on markets and market performance. And the other thing, and I'll leave you with this with IULs, why would anyone put money into an IUL when the markets are at the absolute highest point and there's a very, very good possibility, knowing what I know, that the stock market's going to come down, which if you're in an IUL, that means you're going to go from whatever hypothetical return they gave you, 6, 7, and you're going to come down to close to zero, whatever your floor is, and you're going to sit there until this recession's over. So you're going to lose all that interest earning potential during that period, and the fees are not going to stop. So I didn't mean to hit that too hard, but I hate IUL, and there's too many people saying that IUL works the way the whole life does, and it absolutely will not work that way. Let's see, come down to Mexico. Heck yeah, man. Where are we going? Dana, we going to Cabo? Where
We're in
surf?
Cabo. We're in Cabo.
Oh my God, Cabo is my favorite. I was just there for a mastermind and I surfed this unbelievable point break. I can't think of the name of it. It was epic. It won't take you very much to get me down there. Put a couple people together in a room. As long as I'll do my presentation. The rest of it is surfing, man. That's all we're doing. No foam boards. The guy gave me a foam board when I was down there. JA said, can you cancel the policy? You might not need to cancel it. I'd have to look at it. And you know, if you're using it for life insurance, if you bought your IUL with a primary goal of having it as a death benefit, keep your IUL. But if you bought it for cash value, then that's probably not going to work so well. And yes, then we could do what's called a 1035 exchange. But you just got to be careful. Yes. Oh my gosh. Copy of the book. Holy smokes, folks. I am so sorry.
You do, Chris, for the ebook, what you can do for the ebook, if you've got a link, you can pop it here, or we can put it on the Facebook. I've tagged you on the Facebook video. You can pop the link under the Facebook video.
Okay.
Here in the chat.
I don't know. Hey, Shauna, do we have a link for the ebooks, or is it something we have to email?
If you email it to me, then
I'll email it to you.
I can put it on the as a downloadable file. On the group.
Perfect. And for any of you looking for the hardcover, right there, that link, moneyschoolrei.com/new book will bring you to a link. You can get the book for free. You just got to pay the shipping. That's all. And then we'll mail it right out. And I try to sign every single one of them. We've been shipping like 40, 50 books a day. So it's been tough to get to everyone, but I will make an effort, especially if I see any of your names come through.
Brilliant. Any more questions? Because I know we've been on for
I know I went long. I'm sorry, folks.
No. You gave us a lot of amazing information. I think everybody now understands that. And I think a key thing, which I'm going to leave everyone with, is if you're respecting your money the way that you respect the bank's money, this is the potential. When we're looking at those of you who are paying down your bridge loans on your credit cards, getting the bridge loans to pay down your credit cards, why not run it through your bank and then lend it back to yourself to pay off?
Oh, I love that. Dude, we have strategies for that, and I'm glad you brought that up because that is so powerful.
So, and you and I will have a chat about some of the other things to do. But I'm gonna let you guys get on because I'm late for a call as well.
I know, and me too. I'm so sorry.
No.
I hope you enjoyed it.
This was amazing. This was amazing. Thank you so much, Chris. Make sure everyone, Chris's details are there. He's given us his contact information. I'm going to pop this link on the Facebook as well. Please join me in thanking Chris. Chris is actually he's in the Facebook group as well. He's kindly agreed to join our Facebook group and be available for us as a resource. Those of you who are in my accelerator program, I'm giving you 3 months at his money school, which is a really, really great program. Wow. So yeah, I think you're
going to love it. And I'm going to email you both of my ebooks. Instead of giving them one, give them both.
Thank you. You're a gentleman. Thank you so much.
Thank you both.
All right,
and everybody.
thank you, everyone.
See you soon.
Bye.